Very pleased to be here in Métis Region 5, part of Nipissing District, and of course the city of North Bay.
It's my pleasure to talk today, and I know that Charles kind of labeled this a tax talk, and there will be a significant component to it, but I think in talking about growing Northern Ontario, which is the topic that I've given in a sense for this session, is that you have to talk a little bit more than just taxation, because taxation is only one instrument of many policy instruments to influence growth. And of course, growth is important, and I'll come back to some of it why, but as we know that our standard of living really depends on how much we grow. And of course, the more growth we have, the more income we have, the more revenues governments have, et cetera, and the more that we can do. And that's why growth is still very important, and it's important to think about. And of course, if you go back in history, Canada, had a really tremendous period of growth between 1867 and up to the First World War, as we know, and it was partly through immigration, but it was through development. But I've been reading a book called 1913, which was about the world just the year before the start of the Great War, World War. And that book, I think, is kind of interesting because it goes through a whole bunch of cities around the world, as well as various countries, basically giving a background to them. And of course, one of the interesting things when you read the book is that there are two things. One interesting thing, and that is nobody predicted the Great War the following year. And of course, nobody predicted the Depression coming up, and nobody predicted a Second World War. And so for the next 30 years, any forecasts that were made in 1913 about the world, what it would look like 30 years from now, were, of course, totally wrong. Which is one reason why I never like doing forecasts myself, because I know that trying to say what the world's going to be like in 2050, for example, as we sit here in 2018, I think it's a very brave thing to do. And I'm not Joseph in the Bible that has dreams that can go tell Pharaoh a few things like, save for 7 years because you're going to have a famine after the next 7 years. So I think that, we have to be a little humble about what we think about in terms of the future. One of the interesting things about this book is that the country that was viewed actually prior to the First World War as the greatest growth potential was not Canada, was not Australia, and was not United States. It was actually Argentina, because at that time Argentina grew from being a wheat importer to a major wheat exporter, also a meat exporter. Trains were being built. There was 100,000 Italian temporary workers that came every year to Argentina to carry out labor activities to support the country. But as we know today, the difference between growth rates that Argentina had since 1913 and what Canada and Australia and the United States have had since 1913 has been remarkably different. And obviously, Argentina did not become the fundamentally growing economy that everyone predicted at that time. In fact, Theodore Roosevelt came there and said, you're fit to be a country of a champion of your own with the Monroe Doctrine. In other words, he looked at Argentina just being as comparable as the United States potentially in 1913, and that did not happen. So it does tell you that growth can make a very big difference over a long period of time. And sometimes when you look at just small differences in growth rates, whether it's 0.2 percentage points or 0.3 percentage points, we think it's very small and it doesn't matter too much. But over 50 years, it can make a huge difference in terms of the actual standard of living that people can have. And that's why I think it's very important to think about a growth strategy. It's not the only thing. I agree with the comments that were made earlier on that. But we also have to remember that it's very important that growth happens, because if it doesn't happen, misery often comes along with it. So what I'm going to do, and I don't, here's the clicker. I forgot to ask about that. Anyway, so I'm going to first really have two parts to my talk. The first part is I want to set up how Canada's been doing in terms of growth. And I want to paint really a picture that Canada has had a lot of challenges over the years. We haven't been too bad, but we've had particularly a rather poor record of productivity. I think this is kind of well known. A lot of economists have talked about it. In fact, the debate is, how we can ever improve it. But certainly there's been some changes that are occurring now, and I think productivity is going to be something that's going to happen worldwide as companies adopt new technologies. That, of course, has all sorts of important impacts, but one of the things is that some countries are going to move very far ahead than others. And I think it's no accident that United States, when you come down to it, the gang, Google and Apple and Netflix and what was the other? Anyway, forget the other one. Anyway, but when you look at the 4 top technology companies, they all come from the United States, not from Europe and not from anywhere else. And that has given huge amounts of growth to the U.S. And I think we're in for another long period of economic growth there, which of course has some significant benefits to Canada because we're next door and we can take advantage of that. So let me begin really with what I think is our challenge, and I'm going to get into some tax information. And then after that, I want to talk about Northern Ontario and what some of the things Northern Ontario can think about. So it's going to be a little different than talking about tax policy at the national level. I don't think that's as relevant as thinking about Northern Ontario and what Northern Ontario can do. So the first picture here is really all about GDP growth, and it's from 2015. Blue, by the way, is for Canada. Red is for United States. I know it's a switch in colors, but it's a test to see that you're still awake after lunch. And you can see that Canada actually did have a tough 2015-2016 period relative to the United States, growing less than 1.5% of GDP, actually. But it did have a very good 2017 year. By the way, these are annualized growth rates, so it's 4 quarters worth. And 2017 was very good, but in 2018, Canada's now dropped back to 2% growth, while the United States is going through a takeoff in 2018. And of course, that's a big debate, because the question is, why is the U.S. going through this remarkable growth actually in 2018? In fact, the second quarter was 1.4% growth. Canada was 0.7, actually was better. Problem is that Canada had 3 previous quarters of only 0.4 only, so the total is 1.9. But the U.S. has really picked up speed in 2018. And of course, we know that one party would argue, and I won't say what that party would be, but they would argue that deregulation and tax cuts have had a major impact on growth in the United States. Now, I'm going to get into that a little bit later on. I don't think it's the personal tax cuts. I actually think it was the corporate tax reform that has really had a big impact in the U.S. and will have a sustained impact at least for a number of years. However, when you look at the overall growth rates at roughly 2% for Canada, the question is, why is it that we're plodding along at 2%? In fact, at one time we used to be closer to 3%. And that's because we've had 2 trends that are very important. One has been what affects growth is how many working hours that people add on in terms of employment. And so one likes to look at labor population, or better still would be working hours in terms of growth, but certainly that's one source of growth. And the other source of growth is productivity, which is the amount of output produced per working hour, which is, in my view, the best way of measuring it. And I'll probably give you I'll show you in a moment the numbers, but effectively Canada now is stuck in kind of 2% growth, and that's because, first of all, our population growth is roughly around, let's say, 350 to 450,000 people. That's a little bit better than 1%, but as you can see, it's been roughly 1% actually for a very long time, going back even before 1999. But if you're growing at 1% in terms of population growth or labor growth, which would be a better measure of that, you're not going to do much better in terms of that part of your growth rate, because growth is really just the adding up your population growth and your productivity growth. And if you look at where that population growth is coming from, it is primarily coming from immigration now. In fact, immigration makes up 70% of the growth in population today. And that, of course, has very important consequences for Northern Ontario. And I was looking at the numbers that Charles gave this morning. And of course, there's been a decline overall in population growth in Northern Ontario. So that's actually negative as opposed to 1% per year. But if Northern Ontario is going to do better, they either have to do it through natural growth in population, which right now we know the Indigenous population has very good growth in terms of its own population, but that's only a part of the Northern Ontario growth. But if on Northern Ontario also will have to count on people moving to Northern Ontario, whether it's from other parts of Ontario, other provinces, or internationally. And of course, that's a challenge about how you do that when you look at where some of that growth is going to come from. Now, the other part of growth is labor productivity. And this is, right now, this is a measure just taking an index based on 2010 of output per working hour based on OECD measures. And you can see that the Canadian line, which is blue, is relatively flat. In fact, productivity is growing about 1% per year. There was a bit of a pickup in the early part 2000 on, but then it's been pretty flat, especially after 2008, and continues to be flat. In fact, since 2010, it's been flatter than the United States, although the US has actually had a decline in productivity to a little bit better than 1%, because they normally have been 2%, which you can see in the earlier years of those decades. Now, I could have gone further back with this diagram, but the main point is that productivity growth in Canada has lagged. United States, in fact, it has lagged the average of all OECD countries. And so we have a challenge when it comes to productivity. And I can tell you, sitting in federal policy circles over the years at the federal government, both under the Liberals and the Conservatives, as at the Department of Finance, when I did a lot of work over the years, as well as and in many of the provinces, that the productivity issue is one in which we have failed at boosting up our productivity rate. In fact, despite all the Canada Research Chairs we've created at universities, and despite the personal and corporate reforms that we undertook since the year 2000, and despite all sorts of other things that we've done, we have not been able to edge up the productivity rate. Now, it doesn't mean that these policies haven't been useful, because maybe our productivity rate would have been worse if we didn't carry out some of the good changes we made. But we still have not been able to achieve something like a 2% productivity growth rate in this country. And in fact, I've done a lot of work with the World Bank and the IMF, working on many countries around the world during my career. And there are some countries that have succeeded in achieving 2% productivity growth rates, but we haven't been able to do that in Canada. And so the big question is, how will we achieve that if we really want to get something better that our incomes will grow more than they possibly can? Well, of course, productivity depends on a whole bunch of other things. It's our human capital. Actually, one thing Canada does very well is education, relative to a lot of other countries. We've had a good education system. Maybe it's not perfect. Maybe there's things to improve upon, and I think there are. But at least relative to other countries, we can't argue that we have a poor human capital in this country. I don't think that's been a significant problem. But where we have had problems, I will argue, has been particularly in private investment. So the next thing I want to show you is the fixed capital formation. And so we try to take out residential investment, which would be in housing, just to get a bit of an idea of what actually goes into what you might think of as business capital. whether it's private or public. And so when you look at gross fixed capital formation as a share of GDP, and these are based on OECD numbers, you can see that Canada has had a big fall off since 2014 compared to United States. In fact, we're well below the US. We did do better 2010 on than the US in terms of in terms of gross fixed capital formation, taking out the non-residential side, the residential. But our residential investment has been very high, by the way, so that's been significant as well. But if you look at the earlier years, US has been having much higher investment as well. Now, the trouble with all this data is that it includes public infrastructure, so not to say that public infrastructure isn't important, it is, but I think also you want to have a sense of what you're doing on private investment. So before I show you something on private investment, I want to show one other particularly important aspect, and that's foreign direct investment. And Canada's always been dependent on a certain amount of foreign direct investment coming into the country. That's historical, although around the mid-1990s, we switched from being a capital net importer to a capital net exporter. In fact, we pretty well stayed that way since then. But as you can see, that if you go back to, let's say, 2006 and to 2012, part of this driven by the strength of the resource sector, foreign direct investment flows were up to 25% in 2007. And of course, something called a big recession happened in 2008-9. Foreign direct investment dropped, but then it started picking up right again to 2014 to 20% of all North American investment. This is Mexico and the US calculating these shares. And then it's been tracking down again with a little bit of a blip in one quarter in 2007. That's probably somebody did a takeover. And now it's again gone down a little bit. But you can see the trend has not been particularly great. In fact, we're not attracting that much more foreign direct inflows than Mexico, at least in North America. And that's something I think, this is not a tremendous trend, as you can see, but it's a worrisome because foreign direct investment does have a certain value. As discussed in the question about acquisitions, why foreign direct investment can be very important is that it gives more competition to management. And if you have somebody comes in, whether it's actually a domestic buyer or a foreign buyer, and is willing to take over a company and offer shareholders a premium because they think they can run that company better, that actually could be a very significant economic gain to the economy. And so I think that's one of the reasons why we have to think about foreign direct investment as being a positive thing. Some of you may have heard me on state-owned enterprises. In fact, I'm not as convinced state-owned enterprise investment is a great thing for Canada. We've actually had a lot of success privatizing our crown corporations. There's more to do, but I think we've had that success, especially when you look at what's happened to Air Canada and Canadian National, and you can run through, the cane wheat, Viterra that came out of the cane wheat pool, et cetera. These companies ended up global companies in many cases, and so I've always taken the view that why do we want to renationalize the Canadian economy, but not with domestic crown corporations, but with foreign crown corporations or state-owned enterprises. I have some serious concerns about productivity impacts, especially since state-owned enterprises can come in with certain advantages that could lead to more acquisitions due to the support that they get from their national governments, like zero interest loans and free land and all sorts of other things. So I think that's an area that I think we need to think about, including for Northern Ontario in terms of what it's going to do. Now, let me though turn to the private investment side. And if you take out public administration, health and social services, and education, which are primarily public sector and you just focus on private investment, and by the way, this is the latest year that we could update this to. We're waiting for another year of OECD data to work, or World Bank data to work with this. But this is a comparison between the period 2011 to 2015, sorry, 2010 to 2015, looking at private investment as a share of GDP. And I think this diagram says something very important, and that is how poor Canada has been doing. We do actually quite well in the resource sector. In fact, next to Australia, where we have the largest resource investments. This is mining and et cetera, and oil and gas and forestry. But what and our manufacturing is not too good either, despite having a 2-year write-off for manufacturing equipment or for many years. So it hasn't done that well as a tax incentive. But where we really lack is in the service sector. Even though the service sector is 70% of GDP roughly, and services including retail trade, wholesale trade, telecommunications, which is really important for investment technology or information technologies, et cetera, transportation, construction, and et cetera, utilities. All that's what we include in services broadly defined here. Canada does really poorly in the service sector. In fact, it's in these years, we're only getting 7% of GDP. In fact, it's worse than Greece. I mean, that's really pretty bad. In fact, we're worse than every other OECD country in this group. By the way, we didn't pick the OECD countries. We only picked the OECD countries that we could do this calculation for. Not all OECD countries report this kind of data. But it does tell you something, that in the service sector particularly, we've been doing very badly. And in fact, if any of you know the work that I've done on effective tax rates on capital, which I'll get to in a moment, but it's usually, over the years, Canadian governments have socked the service sector the most with taxes. They pay much more taxes as a share of their profits, taxes on their capital as a share of profits, than any other industry. That's because we've always had a system much more biased towards resource sectors and manufacturing sectors in our tax system. And so, and actually, when you look at our so-called competitiveness, one of the areas we do very poorly on is actually the taxation of service sectors. That's the area where we tend to be very high, and especially in some provinces which still have retail sales taxes, like Manitoba, Saskatchewan, and British Columbia. And so that's, I think this is a very important thought, and I wish I could add more years onto this data just to see where we're at, but I think it tells us something, and I have not seen anyone really break down the sectors like this to get this kind of sense of how private investment is doing. And as you can see, Canada is actually, even with the resource sector, is still one of the lower ones in the world. So we're not doing very well in private investment. Now I'm going to show you something later that tells me my suspicion is that I would say that even Northern Ontario is worse than Canada as a whole. Well, let me get into marginal effective tax rates. And I have to thank Toby for talking about marginal effective tax rates, or mentioning it. I should mention many finance ministers over the years have, because the Department of Finance does this work, have referred to marginal effective tax rates, and I'll guarantee you that they don't understand a single thing how those things are estimated. So I'm going to try telling you a little bit about the background of what we do. In fact, we're the only group in the world right now that calculates marginal effective tax rates for 92 countries, and we try to include not just corporate income taxes and corporate income tax rates, but we take into account the various treatment of costs like depreciation, inventory costs, et cetera, and the various special allowances like investment allowances, investment tax credits. But we also take into account other taxes on capital, like asset-based taxes, which a number of countries have, and also sales taxes on capital purchases, which includes retail sales taxes in Canada that are on capital purchases, as well as in the United States. But also, you wouldn't believe what various countries do around the world. For example, they all have value-added, many countries now have value-added taxes. There's 150 of them, but they're not necessarily pure value-added taxes. In fact, some of them don't give refunds for some purchases. Like if you buy machines, you may not be able to get, as a company, you may not be able to get a credit on the VAT that's paid on that machine to claim against the VAT that you charge on your sales to other companies. So that's a very significant tax on capital. Should mention China did that for many years. They've now gone to full refundability on machinery, but at one time they actually had a 17% tax on the sale of machinery. That put them at a very non-competitive stage. Well, if you look at these numbers, of course, the big story in 2018 has been U.S. tax reform. And we don't know where all the countries are going to go. We already know that France has announced cutting its corporate rate from 34 to 25%, and Belgium from roughly 34% down to also 25% over the next few years, and et cetera. So we know there's been some responses that are starting to take place, but we'll have to see generally where all the countries are going to, what they're going to do this coming year in response to U.S. reform. But let me kind of give you a brief description of that U.S. reform, because it's more complicated than what people think in terms of just talking about rates and expensing. So first of all, the U.S. Federal rate, of course, has been cut from 35 to 21%. That's a 14-point cut. And even though I recommended to the Republican leadership in the House that they should think about staging that corporate rate cut over time, partly so you don't reward old capital with lower taxes on profit as much. They didn't do that. They were worried about people pushing their invoices into their cost invoices into when the rate is higher. But the U.S. did it all in one swoop from 27 to 2018, a 14-point cut in the corporate rate. Now, of course, there's state rates, and the problem is how do you add up the state rates? They really vary in the United States. The state rates vary from zero, like in Texas and Ohio. Washington State, for example, there's 6 of them that have zero rates. And then, of course, some have very low rates. And then you have some very high rates, like Pennsylvania is the highest one at, I think it's around 12%, if I recall. And they're all deductible against the federal rate. So there's a big variation at the state level rate. And actually, really how you want to measure it is kind of like knowing your taxable income across all the states and adding them all up that way. Nobody has the data to do that. I've been trying to get it for years. So what people often do is they take a GDP weight and just say, let's add it up by GDP. But actually, that's really not necessarily the right one either. And just to give you an idea, for Ontario, I took based on trade with Ontario, I did a trade-weighted weight of the corporate income tax rate in the U.S., and it's about a point lower, because when you look at the states that are the 10 biggest states trading with Ontario, which includes Texas and Ohio, and Michigan, obviously, which has a 6% rate, you actually get a trade-rated weight which is about a point lower than what some people calculate, which is about 26% in the United States. So I get something actually less than 25% for Ontario on the corporate rate. However, the U.S. change on the corporate rate wasn't the only thing that happened. The U.S. also made a huge number of changes to the tax base. And sort of putting it in dramatic terms, over the years, many companies with U.S. operations, whether an American company or, let's say, a Canadian company operating in the United States, would try to keep their profits out of the United States, even though they knew, given the size of the market, which is 20% of world GDP, that they would want to invest in the United States to some degree. So in other words, they put their money into the U.S. for investment, but they would make their biggest effort to actually keep their profits out. In fact, I've talked to a lot of corporations since U.S. tax reform, C-suites and corporate boards, and I actually have been surprised how many King companies operating in the U.S. were running taxable losses. In other words, they weren't paying any U.S. tax in the United States because they would do whatever they could to try to make sure they got their profits out of the United States rather than having it in the United States. Well, the U.S. reform has a huge impact now on that psychology, because now, instead of keeping your profits out of the United States, you want to put your profits in the United States. And it's not because of the corporate rate. That's not the reason. It's one reason, but it's not the only reason. It's because the U.S. has brought in a whole bunch of rules that make it very difficult to run subsidiaries in the United States at losses. Some of these include limitations on interest, the ability to write off past losses against future income, also something called the base erosion anti-avoidance tax. This especially hits any foreign company operating in the United States, where they can have payments that are made to the parent in their own country from the United States being disregarded. And so the way to avoid that, you have to put more taxable income in the United States to avoid that special tax, et cetera. I won't go through all the technical details, but those are a number of things that are really important. And there's also another change, which I'll talk about in a moment. That's the whole treatment of what's called intangible income. Well, that has a very big change. That's made a very big change. In fact, Tax Planning 101, if you're a Canadian company and you were putting a subsidiary in the United States, you would never use the U.S. to be the parent for a whole bunch of subsidiaries around the world. You would never do that. And that's because of the fact that now, but that's now changed, because now, if you put a subsidiary in the United States, first of all, you can create more income in the United States, or you want to have more income in the United States, but now you can bring your dividends from other countries back to the United States tax-free, which didn't happen. This is the first major change that's occurred in the United States with this latest reform. So that's another aspect that's encouraging a lot of companies to now look at the U.S. as being a headquarter jurisdiction, which they've never done before. This is going to be the first time in 2018. And then the final change that's really important is the treatment of intangible income. What's intangible income? Well, it's intellectual property income, it's your sales and marketing income. Believe it or not, it's your mining income, like exploration and development. That's another one. Oil and gas, by the way, is excluded from this. I won't try to explain the policy thinking in the United States for doing that, but that's what they did. And the key point is that the U.S. had brought in this new rule where any income in the United States called foreign-derived intangible income is taxed only at 13.125%, not 21, but 13.125%, which is significantly low. And the numbers that I show you here doesn't include that, but that actually is a very significant change as well. And so a number of companies I'm talking to, they're already looking at moving, or have started moving sales forces down to the United States because of this low tax on intangible income. They're looking at putting intellectual property there, although if internationally they've already been putting it in other countries which have even lower tax rates, like the United Kingdom, they'll do that instead. But the main point is that there's now a shift of income from Canada going on down to the United States. And so the numbers here, which I give you as these marginal effective tax rates, U.S. now slightly below Canada, it really hides really more that's going on here. The differential state rates, the fact that intangible income now is taxed at a much lower rate than Canada, where now intangible income is almost 27% in Canada, in Ontario it's 26.5%, including mining income. There's a huge incentive now to move it down to the United States. And in fact, companies are starting to do that, or are actually doing that, at least anecdotally, and we won't know from the data for some time. Now, of course, Canada doesn't look as bad as some regions of the world. You know, we tax capital a lot less in Asia, including India, and we don't have as much of a as a positive, or at least a position relative to Europe. But relative to Latin America, we actually tax capital a lot less than Latin America. But that just kind of gives you an idea of the competitiveness challenge Canada now has with the U.S. tax reform, because the U.S. obviously is our most important trading partner. It's still 75% of our exports, and the very large share of our capital that we compete with in North America. And that's why many Canadian businesses, as well as U.S. businesses, are looking at not necessarily closing down investments in Canada, but looking at shifting more activities down to the United States over time. And in fact, the IMF has predicted, actually, at least for U.S. companies, a fairly significant reduction in capital investment in Canada. I forget the number right now, but as a result of the tax changes that have occurred in the United States, and they didn't take into account the tax on dividend on intangible income that I just talked about. Now, you might be interested to know, how does this do by industry? So forestry should be of fairly importance. U.S. now is going to it's the orange bar, and Canada currently is the blue bar. Forestry is actually going to be taxed much less in the United States compared to Canada. You can go across some of the sectors. Manufacturing actually is not that much different, and that's because we have this 2-year write-off for capital. And of course, in a number of other sectors, we're almost the same as the U.S. or slightly below, but the ones that we really are well below will be much higher than the U.S. will be in transportation and storage and communications. And of course, those are important, I think, from a number of important perspectives, including what the new economies are going to be all about. Now, the one I don't have here is mining. And so let me give you mining. We have done mining, and I'll be putting out some data on this. But mining actually is very favorably taxed in Ontario under both the mining profit regime and the corporate income tax. In fact, the effective rate is only 5.5%. So mining actually gets a really low effective tax rate in Canada, in Ontario. By the way, in Quebec, it's 9.1%. So it's pretty favorable in Quebec as well. While in the rest of Canada, we're looking at the average rate being more 20% in Canada. And so a little over 20%, close to 21%. So mining actually gets a pretty favorable treatment in Canada, in Ontario and Quebec, as well as the other provinces. If I gave you all the numbers, I could do that. And so that tells you something about the position of mining. Canada, we still have a pretty good system relative. And I should mention the U.S. rates are much higher than Canada, because you tend to have relatively high royalty rates in some of the states, and that depends on the product that's being produced. So on the capital side, we're not all that. We've lost our business tax advantage entirely, and in some areas we're actually going to be quite worse off, and so there are some issues to be dealt with. Now, here are the top personal tax rates. Actually, the Canada one is really Ontario's. The Canada weighted one is a bit lower, it's around 52%, but I didn't have the number right away. But as we know, this hits at a threshold in Canadian dollars about $220,000. The U.S. tax reform lowered the top rate, the federal rate, to 37%, but they eliminated the deductibility of state and local income tax rates. So actually, the total top rate in the United States is about little over 44%. But the big difference is that, and it depends on whether you look at individual filers or joint filers, but at least this gives you if I recall, this is the individual filer number in Canadian dollars is $724,000. So the key point is that if you are trying to compete for small business investments, people who might choose to which part of where to invest, where they want to reside between Canada and the United States, these top rates can really matter. And so let me show you that in the next diagram, which is This takes into account not just the corporate small business rates, but in the United States, we have to remember that most small businesses are organized as flow-throughs, so their corporations don't pay taxes at all. It's a zero rate, but all the income is attributed to the investor as personal income. And so taking that into account, as well as retail sales taxes and all the other things that we do to calculate marginal effective tax rates or the effective tax rate new investment, you can see that Canada now is, when it comes to small and medium-sized businesses, where you have to take into account the personal tax paid by entrepreneurs on their income that they derive from the corporation, are significantly better off in the US than in Canada. So if I was a young person, maybe the small business personal tax rates don't matter very much, but as my business grows and I get older and I want to decide, do I take 8 months and live in US and less in Canada? I might end up choosing to go to the United States, especially under the tax system now, as well as now the depreciated dollar in Canada has put our salaries much lower. So both for skilled labor and entrepreneurs, now we're less competitive in Canada, and that can matter in terms of business costs. Now, but I should say that these were almost equal to each other before the US tax reform. But the US tax reform has made certain changes that I think has driven effective tax rates to be much lower than in Canada. Now, before I go on to the final point, let me just say that, as I mentioned, these estimates are only effective tax rates on capital. And if you're going to properly assess how taxes and subsidies impact on cost competitiveness, and I've done this in the past, what you really need to do is you need to measure first the effective tax rate in capital, then on labor, and then on something like energy. On labor, we have higher taxes in the US, lower payroll taxes, but higher personal income taxes, which means that if you're an employer and you're bringing your employees across the country or across the two jurisdictions, United States and Canada, and you're paying equalization, your costs of labor are going to be higher in Canada, partly due to the tax system. On the other hand, wages are lower in Canada, so that can be attractive for Canada from the point of view of the business costs. And then on the energy side, our energy prices, our taxes are much higher than the US, and of course they're going to go up more because of our carbon policies relative to the United States as well. So when you sort of put it all together, we've lost our business tax advantage, and then some of our disadvantages, whether it's taxes on energy, taxes on labor, or being a small market, or et cetera, that ends up hurting us to some degree. And now there is an advantage with health, and I've done this in the past, and I would say that it does provide some positive impact for Canada, that we have subsidized health care and saves businesses money, but when you still put it in aggregate together, Canada could be at a disadvantage. Now, I haven't done that full calculation recently with the US reform, but I suspect that is the case because I did find that in the past. Now, let me go to one more thing, and that's about the Northern Ontario economy. I asked the institutes for some numbers on sectoral shares, and I thought this was really quite interesting when I started comparing Northern Ontario to Canada as a whole. And Northern Ontario, the resource sector, which is just the primary sector, so it's oil and gas, mining and forestry, and agriculture as well, and fishing. Actually, Northern Ontario is not as resource intensive in that sense. Now, that doesn't mean that there isn't important other parts of the resource sector in the rest of Ontario or in Northern Ontario. For example, the forest sector is very vertically integrated, so there's a lot of manufacturing, like pulp and paper mills and forest product mills that are sitting in manufacturing that is not included in the resource sector. So this doesn't mean that Ontario is less resource intensive than Canada as a whole. But of course, the one thing Northern Ontario doesn't have is oil and gas, which is fairly significant in a number of the provinces. Northern Ontario is low on the manufacturing side, only 6% of GDP. Services is lower, but where, of course, it's much bigger is in the public sector. public administration, health, social assistance, and education, which is almost 32%. That's a lot bigger than what you find in the rest of Canada. Now, is that a good or a bad thing? That's an important question. It does say that many of the people that are employed and working in Ontario, the GDP that's coming out is much more in the public sector than it is in the private sector, which I think gets to my point about productivity and private investment and about the need to do things with respect to that. So let me now get to the final point, or the final discussion, which is the key one, and that is, if we want to spur more growth in Ontario, how can the tax system be used, if at all? And I want to start with three kind of major points to start with. Over the years, I've worked in a lot of different countries, and they all have the regional development policies, and some of them using the tax system, some of them grants, some of them other things that they try to do. And the World Bank actually came to a view, as well as the European Union and a number of others, that a lot of these things don't work. Tax incentives don't work, special grants don't work, regional development agencies don't work very well. And that's because it just doesn't really help spur economies. What they found that actually the two most important ways of trying to develop more growth in a region, especially in a region like Northern Ontario, is to try to take advantage more of economies of scale, especially in the provision of public services, so that, let's say if you have towns that live close to each other, then rather than building an arena for each town, they would have one arena that they would share. So there'd be a lot more cost sharing, a lot more scale, and as a result, you drive down your per unit costs quite significantly. And the other is to try to overcome jurisdictional barriers. You have municipalities and different local governments, and they all have their special rules, and as a result, it really impairs trying to get maybe joint actions taken together. And of course, one of the interesting things about Northern Ontario is there's no regional Northern Ontario government, which I think raises an interesting question maybe for the Institute to think about in terms of overall governance. The other thing that these World Bank studies have shown over time is that you do get more success in developing more communication and transportation networks. Of course, that's infrastructure. And some of it is government, but not all of it is government. In fact, communication networks are completely privately supplied today in Canada, and almost 90%, 95%. It's not a public infrastructure expenditure. It's a private infrastructure expenditure. And so that sort of tells you that we do need more infrastructure, and both on the transportation side and communication side. And I don't think I have to tell anyone in this room about the Ring of Fire and the challenges about infrastructure in that case. And it doesn't have to be all publicly provided. There is a role that the private sector in building more mining facilities could actually develop the infrastructure that's required if the regulatory system would be more conducive to doing these things. And that's a problem that we have here in Canada, is more on the regulatory side when it comes to private infrastructure. But we should never just assume that infrastructure is solely a public expenditure. The second point I want to make is with respect to government efficiency, which I've already talked about, economies of scale and more joint operations, but certainly governance is very important. And I think that's something which you may want to think about more in terms of how the region can grow, whether there are things that could be done on the governance side that could achieve that. And then the third is my point about tax policy. And what I want to come back to is the principles of tax policy. Usually, when we look at tax policy, we're looking at really three objectives. First of all, the role of taxation is to provide revenues to governments to fund public services. So the level of taxes is really based on how much government spending one wants in society. And I'll divorce myself from that point right now. Maybe there is too much government spending, maybe there's too little. I'll let people make that political decision. But certainly the level of taxation will depend on how much spending you want to do. So if you want to reduce taxes, you have to reduce spending. So that gets into a question about the efficiency of government whether we were doing things as well with the kind of structure we have today. But then when it comes to a certain type of spending that you require, or taxes that you need, then it becomes how best to pick the taxes that causes the least pain, which Fred Reardon mentioned earlier on. Taxes and growth are a bit of an oxymoron, because taxes don't lead to more growth, taxes lead to less growth. But the issue is, what kind of tax structure do you want to have the least pain possible? And although we could talk about progressive taxation, I won't go into the details on that. That certainly is one thing to do at the personal level. But when it comes to business taxation, really the role is neutrality, is to get the government out of the boardrooms of the nation and let businesses decide where best to put money and where best to choose economic returns, and not letting the tax system influence those economic returns unless for some reason you believe there's a market failure and businesses aren't doing what they're supposed to do. And that gets into a debate, because it's not clear taxes should be used to try to overcome these market failures. There may be other policies that would be more effective. And so from business tax structure, I think having similar taxes on businesses and similar tax burdens is a really important thing, because actually that leads to more productivity, because you're not leading to a misallocation of capital in the economy. So for example, as a friend of mine used to say, there were investment tax credits for boats, for fishing boats in the Atlantic, very generous ones. And then what happened? You had big boats that came along and they exploited the cod, and that was the end of the cod. And so you don't necessarily want to encourage too much activity in a certain area by picking your winners and losers. I also often say that governments are really bad at picking winners from losers, but losers are really good at picking governments. They're amazing how good they are. So those are kind of my principles a little bit. So let me just very quickly say about what Ontario could consider, at least on the tax side. First of all, I think labor participation is really important, and there's been lots of suggestions that have been made to do that. I think in the case, there are really two areas one wants to worry about, and that's the entrepreneurs, skilled labor, and attracting them. And the other area is actually getting people who are not working. I'm actually, I'll be a little bit controversial. I think that minimum wage laws, that $15 per hour in Toronto, one can have a debate whether it makes sense or not. I don't think it's a good policy if you're really trying to deal with poverty, but because I think there's better ones. But certainly, why would you have the $15 minimum wage in Northern Ontario? It's a very different jurisdiction, and in fact, I would argue that it's far better to have wage subsidies in Ontario, in Northern Ontario, because wage subsidies will encourage people to work, and of course governments have to pay the extra wages. In fact, you can give them almost the same level as a higher minimum wage through wage subsidy, and then of course is what revenues do you get to support that. But I do think that we've had experience with that at the federal level using minimum wage subsidies in some of the provinces. And of course, the United States has had the earned income tax credit. All the idea of giving lower income people effectively higher wages through the tax system. They're clawed back, so not everybody gets them. But it does encourage more participation in the workforce. And I'd rather do that than to have a minimum tax that could actually discourage people from working in the workforce, because employers can't afford it, and then they end up taking all sorts of actions to cut back hours worked in some way. And so I think that's one policy to think about, are wage subsidies. On the education side, well, as I said, we have a good system. I don't think tax training incentives necessarily work. I think that's where you want to use the expenditure side of government or government educational policies in general. But if we were going to address the entrepreneurial issue, I think their thought has to be given to that top marginal rate. And the big question is, should you do something special in Northern Ontario where you actually have a lower personal tax rate, let's say on skilled workers and labor than you would have in the rest of Ontario. Now, this is where the tax collection agreements come in. Ontario has a tax collection agreement with the federal government, and Ontario agrees to have the same base. So you can't really do much with the base in Northern Ontario unless the federal government changes the base, and then you could actually have a federal Ontario approach to something in Northern Ontario by changing the base, such as, let's say, giving a special deduction for people that are in certain skilled professions or whatever. But you can do tax credits. And then the only question is, will they do anything? Will they be effective? And I'm not sure they will. And perhaps there's a lot of experience around the world on these things, because sometimes employers, they see that somebody's getting a subsidy, and then they end up lowering the wage that they're paying them, the compensation, to make up for the subsidy. So, one has to be a little careful in whether one does anything. Private investment. Now there, I think private investment does need to be looked upon. And of course, my argument would be try to move to a more even basis. First of all, taking mining royalties as part of the mining tax system, they're amazingly low. It's actually not a very well-developed base. In fact, there's better bases that one could use for taxing mining, such as in British Columbia, where all capital is fully expensed rather than depreciated as under the mining tax in Ontario. But the rate is too low. So I would actually have a mining profit tax reform where you move to a more, I think, simpler system, have full expensing of capital under the mining tax, but then have higher rates introduced that would allow the governments to collect more money, and especially if that money could be shared with communities in Northern Ontario. The corporate income tax is a different thing. Despite Toby's comments on the corporate income tax rate, I think what people miss is that the value of cutting corporate income tax rates are really twofold. One is that it's neutral across all businesses and business activities, so it's good for productivity. But also, it also helps combat base erosion, which is more important now under the U.S. reforms. But would you have a regionally based corporate income tax rate? And I would argue no. Because if you do that, you're creating a lot of incentives for businesses to try to shift income into a Northern Ontario business and losses or costs into the non-Ontario part of the business, even within a corporation, if you can set up subsidiaries and everything else. And so I think that I'm not convinced that actually that would be a smart idea to introduce, is differential corporate income tax rates by region. It doesn't work very well. In fact, the distinction between manufacturing resources and other types of businesses hasn't worked very well either. Preferential corporate income tax rates by type of firm is not a very good, very good system. But what about expensing? Well, the problem with expensing, there are twofold problems with expensing. It does sound great, you're generating more investment, but it tends to reward short-lived capital or firms with short-lived capital rather than long-lived capital. In fact, it really discriminates against mining firms and other firms that tend to do a lot of structural investments. In fact, that's the weakness in Toby's numbers they presented earlier. You only focused on equipment. You have to really look at all the capital, which is structures and machinery, inventories, as well as what's now Stat Canada now measures are what they call intangible capital, like research and development and exploration development, et cetera. And so really expensing isn't necessarily very good from the point of view of it rewarding some firms more than other firms and creating more distortions in the economy. And that was the lesson that we got out of the 1970s and 80s before we started removing expensing in our system. The other problem with expensing is that companies start running reducing their write off their capital, and then they end up, even though they're profitable, they don't have any taxes to pay. In fact, they have tax losses. And that creates all sorts of pressures in the system. In fact, the 1985 reform we did in Canada, as well as the one that was done the previous year in the United Kingdom, to lower rates and get rid of expensing and investment tax credits and a whole bunch of other things, was all with the aim of trying to get rid of this bank of tax losses that were created, where like 40–50% of companies were not paying any taxes at all, and they were trying to push their losses to other companies so that they could use them. It created a lot of problems in the corporate tax system. And that's because once you introduce expensing, it's very hard to get rid of. In fact, I think that's actually one of the worst features of the 2018 US tax reform, but it's kind of consistent with what they've done since 2001, which they call bonus depreciation. That was introduced in 2001, they got rid of it in 2004, they reintroduced it in 2008, and they were still about to phase it out by 2020 when they introduced expensing, which is still only temporary. In other words, they say it's temporary, but boy, it's sure hard to get rid of. And we did the same thing with manufacturing 2-year write-offs. It was introduced in 1972, finally got rid of it in 1988. We phased it out after 1988 by 1990. And then it was reintroduced in 2006 again on a temporary basis. Well, 12 years later, we still have it. It's very hard to get rid of these things once you introduce them. Now, of course, if you introduce expensing and you get rid of interest deductions, then you're taking away the subsidy to a large extent that would be associated with expensing. And so then the question is, would you limit interest deductions? And that's what they did in the United States to some degree, but not entirely. And I won't go into all that detail. Now, is there something that if one really wanted to do under the tax system for Northern Ontario businesses? Well, another problem with expensing is that, again, there's a tax agreement between Ontario and the federal government. And Ontario has to follow the federal base. So Ontario can't introduce expensing on its own. What it would have to do is it would have to do it with the federal government or not do it at all. But there is a solution, and the solution are investment tax credits. Ontario could, under the tax agreement, can introduce their own investment tax credits, and there could be a special one for Northern Ontario itself. Now, you can even make it for certain industries, or you can make it for all industries. You can make it for structures and equipment. You can do all sorts of things with investment tax credits, as we've done in the past. The Atlantic has had an investment tax credit for years, and of course there's a question about how effective it is as a regional incentive. In fact, that goes back to my point about World Bank, is that they've not found that a lot of these regional tax incentives have worked all that well, partly because so many companies end up not being able to use them because of the fact that they don't have enough profits to be able to use them, and they carry them forward but not at an interest rate, and so therefore they lose value over time, and they just accumulate in large banks. And so they're not as effective as one would hope they would be, which often leads to people arguing for grant programs and other things that governments could use that would be more effective. On the small business side, I've been very much against preferential rates for small business. In fact, I think better incentives for small business would be in the lines of an investment tax credit that would also help them with financing, which can be short for them. And so I do think that there is a value to switching over to that. And of course, Northern Ontario would be a very good place to do that system. To look at getting rid of the small business deduction and putting in investment tax credits instead. And in fact, I would highly recommend that as a possible thing to consider. The personal income tax side is problematical, as I mentioned earlier on, because of the high personal tax rates in Canada relative to United States particularly. But that's an issue that at the small business side, one would have to, I think, address more in a national type tax policy approach. So let me stop there. There's probably a ton of other things I can say on the tax policy side that I'm happy to take up in question period. But let me say that using the tax system for growth is not simple. There are things to do, particularly get rid of the barriers to growth that taxes can create. Simplification is a good thing. More efficient taxation is better. And I think that's really where some of the focus should be for policies in the future. Thank you.
I'm not going to get into a big debate, but I did want to take issue with you saying that privatization has always been good or has generally been good. An interesting example, and this is one that you may not know about, is there actually is a provincially owned telecommunications telephone company in Canada. It's called SaskTel.
Oh, I know that. And it hasn't worked as well as the others, but okay.
Well, actually, the cost of service is lower. The customer satisfaction
They have
rates
not
are
been
higher.
They've not been at the forefront of innovation.
Well, actually, if you do look at some things, they say they have in a number of different ways. They return more to the
Right.
to the government. They pay their workers better, and they pay their CEO about a tenth of what the MTS next door does. And I think people in northern communities also recognize the importance of having a passenger bus line like Ontario Northland, once the private sector has abandoned its private routes here as well.
Well, I just wanted to, there are studies to show this. I think the best work is done by Tony Boardman and his colleague at UBC and Simon Fraser, where they've done a lot of tracking of privatizations in Canada as well as worldwide, and some of the World Bank studies, and they've been generally showing that overall they are been quite successful, especially because they're more innovative. They get more connected to innovations around the world, etc. Anyway.
Just Jean-Pierre Chabot. I'm just wondering if your experience with flow-through shares, research anything you've come across, is that a good way of, and the tax incentives around that for particular sectors, I guess the intangibles, is it's related with intangibles? And
well, it's been used.
Development that might not otherwise happen. What, is that a good way of targeting specific industries, particularly in Northern Ontario? Would that be?
Well, I think the industry that benefits the most are the financiers sitting in Toronto that are floating these shares. Actually, the studies have, there's particularly work that Vijay Jog has done from Carleton to show that flow-through shares has not worked at all that well. It's actually encouraged low economic return projects to enter into the market and low economic return firms. And the lemons start making it harder for the good firms to actually raise capital. In fact, that's a problem with labor-sponsored venture capital credits. That's been a problem with savings credits that some of the provinces, equity savings credits that the provinces have set up, is that once you start trying to muck around in the financial sector, you end up creating unintended results you really don't want. And you end up with low economic returns ending up being subsidized, as well as making it harder for the good firms to raise capital as a result. Because usually when you're trying to raise capital, you're trying, especially equity, it's usually a sign that that you don't have the internal resources for an investment, and so if you subsidize the equity investment that's signaling how a firm is doing, that could actually make things worse rather than better. And that's been the result in flow-through shares for oil and gas and mining, as well as labor-sponsored venture capital firms, as well as the Quebec Stock Savings Plan, et cetera, et cetera. Every one of those, same story.
Next question's over here.
Hi, Jack. Thank you very much for a great presentation and getting us thinking. You did talk about, or you threw out the notion of a regional northern government. Maybe you could just sing a few bars. What would that look like? Have you seen that in other places? Where would we start?
Well, I think it goes a bit to the governance issue about how do you deal with all these small, towns, how to link them better, how do people can express, what they would like to have. Of course, there's administrative costs associated with another level of government. And I'm actually only arguing to do it in Northern Ontario, not necessarily Southern Ontario, Toronto, Toronto has its own government, basically, at least the city of Toronto. And of course, Ottawa, in a sense, has its own government at the through the National Commission. I think it's kind of an interesting thought to be given, because some of the comments that people give are the need for Northern Ontario would be treated differently than the rest of the province, because otherwise you get the provincial government that creates rules that all sizes fit in the same way, and that's really not very good either. So I think it's a thought. I was just throwing it out as an idea, and I think Charles should write a paper on that.
Next question. Oh, there's a question right here.
Thank you. Paul Otten from Statistics Canada. You talked a lot, touched upon the issue of labor participation. We talked about it throughout the day. At the same time, we talked about the aging population. Can we do more to, at least with the tax system, to increase participation by seniors? That seems to be to solve some of those issues.
Yeah, no, that's a good point, and I didn't mention that. The studies that have been done on labor supply, the two what you might call extensive margins, the areas where you get, potential significant impacts of the tax system and other government policies on labor decisions, are when the let's say the spouse that's at home and the children all go into school. That's one point where the system can play a very important role in affecting participation decisions. And the other is actually at retirement, when you decide to retire. And of course, one of the things that we have in our system is a pension system that could actually encourage people to retire at 65. Now, a lot of countries have been moving the pension age up to 67. Netherlands, for example, indexes the age to the expected life in Holland, and things like that. And we did actually at one time at the federal level, we did try to move old age security at least and GIS to age of 67, although I would argue we should be doing it for a lot of things instead. But that would certainly help a bit in trying to encourage that. Of course, we also know a lot of people after 65 are deciding to work because they want to or they have to. It's both things. In my case, it's want to, but in the case of, I know a lot of friends of mine whose pensions didn't do very well, like especially contribution pensions. They ended up working longer because they wanted to have more money for their retirement. But I still think that we should be thinking about that, because especially for the defined benefit programs that we have, as well as some of the other benefits that we give to the elderly that are getting to be a larger number, that's going to put more pressure on the tax system. So for example, we have the age credit, we have the pension income deduction, which personally I would get rid of if we can in some way, and even though I benefit from it now. But there's a number of things that one could do to consider that would, because right now in the numbers that we've done, looking at effective tax rates where you include everything, sales taxes and income taxes and everything else by income group and age, the elderly really get taxed much less than anybody else in terms of effective rates for specific, for each income class than any other one. And that might be a nice thing to do, for the elderly, but at some point that's going to put more and more pressure on governments, and I think it needs to be addressed in various ways.
This has more to do with the governments being able to complete their public infrastructure projects, or maybe less tax burden on Canadians. But what if the Canadian government used the Bank of Canada to fund public projects instead of private financial institutions?
I think that would be a horrible idea, because that would be something you'd be giving to the Bank of Canada that has absolutely no competence in. They are not in the lending business. They are in the monetary control business. And they've also been participants in financial regulation in this country, along with the Department of Finance and several other agencies that are involved with that. But not only that, we've now have the Canada Infrastructure Fund. We'll have to see how that does. But I think it's this, if you really want to do something more, it would be more of this special agency. We also have the Business Development Bank, and I understand there's some other things in Northern Ontario that would provide capital. But I think the last thing you want to do is have the Bank of Canada providing that.
I guess I'm not speaking about providing the capital, but government's having to pay interest. They're paying interest, so they're wasting all that productive money could be used to build roads to the Ring of Fire instead of servicing the interest.
Well, I mean, the question is, why do we have interest? And the reason we have interest is a reward for the patience of giving up your consumption to put it into savings. And it doesn't mean that just because the government provides it that they should not pay interest or get interest on their lending. In fact, the argument for government participation in providing capital, by the way, my whole PhD thesis was on this topic, but the only reason for governments to get into it is usually because there's a market failure, either because there's insufficient risk development in an economy, which I think is true in a number of less developed economies, or because there's, well, actually, it's mainly the risk argument. And to make an argument that there's certain parts of the market where risks are not being well developed is, or at least at least businesses having to borrow at higher interest rates than what the risk is associated with their business, you'd have to make an argument about why that might be happening. Now, one of the conversations I had earlier on is that I think because of the concentration we have in the banking industry in Canada, which is not true in all countries, but because of the concentration of the banking industry in Canada, where the banks have used basically their strength, pricing strength in deposit markets and in business and household lending, and the spreads that they get, that has supported their international activities. I'm not saying subsidized it, but given them a cushion, an important cushion. But as a result, maybe there is overpricing on interest rates because we don't have enough competition in the financial sector. So if I was going to use a policy that would address that, it would be looking at the need for creating more competition in the financial sector.
Okay, so since I'm being sandbagged about regional governance, I'm going to make a couple of points before I turn you over to talking to each other. Number one, the Institute has published two papers on regional governance and the potential for regional governance in Northern Ontario around both efficiency and the attraction for investment. And we have a third, kind of three, on the way. When is David due to have the draft? So our third paper is due sometime in the next 6 to 8 months. Then the second point I'll make, and this is a shameless plug, and I readily admit it, we're celebrating our 5th birthday with a party in Thunder Bay in October of this year and in Sudbury in April of next year. And oddly enough, we have two of the architects of regional governance in Northern Quebec speaking. So Matthew Kuncombe is speaking in Thunder Bay to give the Cree perspective on that, and Jean Charest is speaking in Sudbury to give the Quebec perspective on that. So if you want to learn more about regional governance and how that might further both the economic potential of Northern Ontario as well as address some of our long-term social and economic challenges, I'd invite you to take advantage of those two opportunities. Tickets are relatively inexpensive. It's a fundraiser for the Institute, and you can support all the other kind of lovely work we're up to. And so on that shameless marketing point, I will now turn you over to your last table discussion of the first day, a chance to kind of have your go at at Jack's thoughts and share your own. We'll do that for about 30 minutes, and then I'll come back to just wish you a good evening. So in 30 minutes, I'll see you then, and hopefully you'll have lots of great ideas about all the things that Jack was wrong about and that you think you have better ideas.